Coming up on today's show, stocks crash on the economy roaring, Jensen Huang slams Biden's new policies, TikTok is about to be banned and what it means for Meta, and what I believe the S&P 500 will do next week. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks plunged on Friday as investors digested a final 2024 jobs report that blew past expectations on hiring, raising more uncertainty about the path of interest rates this year. All three of the major indexes raised all of the year-to-date gains with Friday's pullback, with almost everything in the red. Technology, hardware deep in the red, led by Nvidia and Apple. Microsoft was down 1.32%, so too was Google. Meta was a green spot on some news from the Supreme Court and the TikTok ban, but the software as a whole deep in red territory. We saw consumer discretionary was kind of mixed. Amazon was down following the mega caps lower, but the rest of retail was kind of upbeat. This is actually also the defensive sector. Walmart, Costco, Home Depot, Lowe's, Target, they were kind of green, so a bit of a defensive trade happening. However, other defensive sectors, stuff like utilities, didn't see the same upbeat action, and same with healthcare, with only Eli Lilly leading the pack, but net healthcare was in the red as a whole. So there wasn't even a defensive trade today. It really was just a liquidation of sorts, with the only defensives being consumer staple that we saw a rotation into. Energy was kind of green, but yeah, red across the board, across all sectors. Even financials were very, very red today in light of earnings next week. And then looking at the sector analysis, the only place that was actually green was the XLE, up 0.39%, the energy sector. And then we had down 0.56% was utilities, followed by healthcare. Both were down 0.56%. So yeah, I guess you could say there was somewhat of a defensive rotation. However, there was still very clear selling in utilities and healthcare, just less so than stuff like real estate, financials, and technology. Anything cyclical really took it on the chin today, with the S&P 500 falling 1.53%. Every single sector of the 11 main sectors was red except for energy. Across the board as well, small caps, mid caps, large caps, it was a brutal day across the board, guys. It was very, very ugly, and it wasn't just the US. Globally too. I mean, Europe was red, Asia was red, Southeast Asia, Australasia. I mean, Southeast Asia was actually kind of all right. This is the semiconductor belt, and that was because of Taiwan semis. December revenue report, we'll talk about it in the video, but North America, South Africa, Europe, everywhere was just brutal. China, India, very red on the back of that stronger jobs report, as well as some of the stuff we saw on the geopolitical front. But let's actually talk about why we were down today, and it was very, very simple. The December non-farm payroll report showed a healthy labor market. The US economy added over 256,000 jobs in the month, while the unemployment rate fell to 4.1%. And that's also because we got some very positive revisions in the past 3 months, extremely positive revisions. We actually had up revisions to the non-farms. The unemployment rate fell. The consensus was for 4.2%. It fell to 4.1%. And that's actually really good news for the consumer, the labor market, and the economy. The reason why the market took a plunge today is because now the markets are only pricing in no easing before July. And if we keep getting the stronger data, that July target is going to move further back into the year. And there could actually be a point this year where we don't get any rate cuts if the data keeps coming in like this. 256,000 non-farms against 160,000 with minimal revisions to previous months. I mean, the labor market is strong. This economy is roaring. The unemployment down to 4.1%. Average hourly earnings month over month, year over year came pretty much in line. A little bit weaker year on the year over year. That probably did help a little bit with the price action. We saw 3.9% actual versus 4% consensus. The participation rate was largely unchanged. However, consumer sentiment via Michigan came in slightly below expectations, but inconsequential really. Non-farms really moved the market. And guys, now we have to start talking about, right, strong economy, what that means for inflation versus what that means for rate cuts in the market. Now, I'm always a proponent for a strong economy, and I think yes, the markets are going to sell off. I think we are going to have a little bit of a deeper pullback. But if the economic data continues like this, I think you want to buy that dip. I mean, longer drawn out cutting cycles amidst a stronger macro backdrop, equities tend to do very, very well. The American economy is built on the consumer, and the consumer has jobs, and consumers are getting paid well for those jobs. Now, there was a lot of red in today's price action, but let's actually talk about some of the market movers and some of the green we actually saw in the market today. Delta Airlines up 9% after exceeding analyst expectations for both the top line and the bottom line in the fourth quarter, kicking off earnings season absolutely great. Now, they're capping off a record-breaking revenue year in 2024, exceeding pre-COVID levels, and Delta shares were up as a result. What this company has managed to do in the last 18 months after COVID, absolutely insane. Well done to every shareholder that holds Delta Airline. Now, Meta was actually very bullish today. It was up as much as 3% here at the peak at one point, following the conclusion of oral arguments before the Supreme Court on the fate of TikTok's US operations. The competitor to Facebook and other US-based social media sites is on track to be banned 19th of January unless its Chinese parent company sells TikTok. Initial reporting on the Supreme Court case indicated a majority of justices appear ready to uphold the ban. So there might not be TikTok unless they sell it to a US subsidiary or a US company. We'll see if that's going to be the case. And if they do sell it, Meta might actually be in the front running to pick up that stock, but that'll be dependent on regulatory approval. And based on the current regulatory environment, Meta could actually get it if the new FTC chair would be for that. Nonetheless, this is really good for Meta and all social media stocks because it just means your competition is getting wiped out. Your competition is literally getting removed. Another huge market mover was WBA. The pharmacy chain surged nearly 30% Friday afternoon after beating Wall Street's estimates on its adjusted earnings per share and sales for the first fiscal quarter of 2025. Even as questions remain about its future as a public company, the company reported $39.5 billion in revenue for the quarter, up 7% from the same quarter last year, and above the consensus estimate of $37.3, up 30%. Yeah, the stock is still down about 85% in the last 5 years. Nonetheless, shareholders rewarded because the management team are taking the right steps in the right direction. Another stock bucking the trend was TSM, Taiwan Semiconductor, and that's because they reported their December revenue sales results. They saw a month-over-month increase of 57%, and for the full year, they saw a 33.9% increase in revenue. However, these upbeat stats were not able to hold up the overall semiconductor market because Nvidia shares came under pressure with the broader market, yes, but also in light of new chip exports, which are to be announced by the White House soon. And this is the Biden government, not the Trump government. And Nvidia CEO Jensen Huang came out and absolutely smashed these, said they were terrible. And we'll see what these chip exports to China will look like under Trump administration. Nonetheless, guys, Nvidia was down 3%, and for everything we saw today in the market, there were 47 decliners, 1,500 advances. Market breadth was terrible. We saw, look at this, anywhere from 0 to 5% declines. We saw nearly 4,000 stocks in that area, and that's why it was a brutal day across the board. And we also saw some very terrible market breadth here with stocks above their moving averages. We've lost every single moving average. Now, this is the S&P 1500. We lost the 200-day. It was the last straw. However, guys, when you do actually look at the S&P 500 in aggregate, which is 80% of the US equity market, right, you can see that 53% of S&P 500 stocks are still above their 200-day moving average. Only 47% are below. So, yes, the S&P 1500 equal weighted net is not looking good. However, the S&P 500 is still hanging in there. And guys, hopping on the charts, we could see a very ugly day here in the markets across the board, and rising yields were just weighing on the overall market. and rate cut expectations amid that strong economic data. The 2-year, 10-year, 30-year yield all rose. The dollar was very, very strong as well, nearly at the 110 level. And look at the 30-year yield, guys, nearly at 5%, just shy of 5%. I mean, if we get a couple more strong data prints next week, I mean, this is probably going to 5% in the 30-year. However, the 10-year sitting at 4.7%. So yields just keep creeping up. If we actually look at the chart of the 10-year, this is where the Fed actually started the cutting cycle, and we've seen yields absolutely soar since then. The 10-year yield at about its 1-year high, closing at that high. So from here, if we do see a breakup, we probably go to the 5.1, 5.2%, the high we saw in 2023. However, if we do find a bit of resistance here in yield, we can actually go down, but that's all going to be dependent on the inflation data that we actually get next week. Nonetheless, rising yields are having a tangible effect on the equity markets as a whole, but not necessarily the economy. The economy keeps chugging along as per usual. And look at the dollar. The dollar rise 0.44%. So those invested in non-US dollars, someone like myself, this is actually a tailwind. So in other words, right, the S&P 500 was down 0.54% today, with the DXY up 0.44%. If I hold the S&P 500 in Australian dollars, my loss today is actually 1.1% net. Nonetheless, an ugly day in equities. S&P 500, NASDAQ, the IWM, small caps, the RSP, brutal today. The IWM, the worst, down 2.2%. You can see, look at this extended hours trade as well. Not looking that great. Pretty much flat, but slightly in the red. And then we actually did see a couple of safe havens in it. Bitcoin did rise on the back of the data. Gold was up 0.75. Silver was up 0.93%. So we did see a movement into the metals, along with some of the defensive rotation we did see into staples, into health. So we did see a safety trade. However, WTI was up 3%, Nat gas was up 6%. So we just saw commodities take center stage today, along with Bitcoin. Bonds fell, and then equities. No one wanted anything to do with equities. So it looks like the bond and equity correlation is back to positive. Now, looking at the S&P 500, guys, we've maintained a very, very solid. Now, we've said two things the last couple of weeks. We said if this level holds right here, they put support, right? This is going to be the opportunity to buy the dip in Q1, because we are looking for a dip in Q1. However, if we break below and consolidate here and continue to move lower, then we will actually see lower price action. If you actually want the exact level I'm looking at, now, this is a Twitter post I actually put out on the 2nd of January. The S&P 500 will bottom 55.48 between the 1st of the 10th and the 18th. So I think we're going to see a bottom at around the 5,500 level in the S&P 500. I posted this when the S&P 500 was at 5,900. You could see it on the 2nd of January. So this is what I believe will happen. For those of you that follow me on Twitter, you actually know this has been my stance for the better part of the last 2 weeks, especially heading into January. And you can see we have actually then broken the put support right here. So we probably will go lower. The put support didn't move lower, so that is largely constructive. We may see a little bit of a relief bounce here in the S&P 500 early on in the week. But if we stay below this put support level and then the put support or the put wall moves lower, we will then probably move lower to the 5,700 level and then the 5,600 level, right? Maybe close the Trump gap up we saw right here, and then we will aim for the 5,500 level. And if we actually take a measured move from where we are right now to the 5,500 level, it's about a 10% drawdown. And that's actually very, very healthy momentum. I mean, for all of the commotion we've seen in the S&P 500 right now, on a peak to trough basis, it's just been a 4% pullback. It's sort of been a garden variety pullback here in the S&P 500. A little bit more exorbitant on the IWM and the RSP. But for all intensive purposes, guys, what we're really seeing in the market right now is just a correction in time, and that might actually propel to a correction in price, seeing a 10% drawdown to the 5,500 area. Now, that could bottom anywhere between now and January OPEX, but I do think we're probably going to find a bottom here in January. The macro is looking very favorable, and then we probably will move higher in the S&P 500. I don't think equities are going to fall apart. I think if we do get this 10% pullback in the S&P 500, you just want to buy that dip, guys, and you want to buy that dip. And so what you guys should do is go ahead and follow me on Twitter, because I post a lot of nuanced stuff on Twitter and my thoughts on where I think the S&P 500, looking at the NASDAQ 100, the put support didn't move down as well. This probably will move down on Monday if we get another trade day like we did today. However, the options market is still fairly sanguine. Nonetheless, we could see a pullback to as far as the 20,000 level here in the NASDAQ 100, especially if we get this relief bounce, use this put support zone as resistance, and then continue the move down. I think that's what we're going to see early on in the week. a little bit of a relief rally, a bounce, and then we're either going to use this zone as resistance and continue the move lower. However, if we actually go ahead, break, and then move up, I think that's what's going to happen. But don't discount the strength we've seen in this market, right? We could actually go ahead, break, and if we consolidate above the put support, that could lead to higher price action. However, I do favor downside from where we are right now. However, there's a lot of stuff happening next week, particularly with earnings, particularly with data that could really see the markets rally, especially with the CPI. If that comes in, cool. I think markets can actually put in a bottom right here. Nonetheless, do expect a dip, especially in the S&P 500 to as low as 5,500 over the next 10 days, but we could actually bottom anywhere inside this zone. It's not an exact science. I'm sort of calling the absolute bottom, but we could actually put in a bottom anywhere between where we are right now and the 5,500 area. Looking at the RTY, the IWM, similar situation. That's all we've seen, guys. We saw some consolidation here in this negative gamma area. We've broken the put support, and it definitely does mean we probably go lower. However, again, relief bounce, use it as resistance, and then move down. But if we do break above, consolidate, and get the data we want, we can actually see upside. But I am in the camp of favoring a little bit more downside into next week. Not without some volatility, not without a dead cat bounce, not without a relief rally, but I do think we will see lower prices into this Jan OPEX, into the inauguration. I think the inauguration is really going to be a buy opportunity where a lot of people were saying sell the inauguration. I think you want to buy the inauguration. I think that's when the markets are really going to bottom, and then we're going to go up from there. Now we are still looking for that bottom in Q1, and I think equities are holding up in my personal opinion. So any dip you do want to buy that dip, because equities looking good, the macro is looking good, the earnings picture looking good. Look at some of the earnings we got from Walgreens and Delta today. We kicked off earnings season this week very, very strongly. Next week, we get the banks, and we want to see continuation. So guys, we're in for a volatile week next week. We are probably going to go lower. There's probably going to be some upside days. There's going to be some downside days, but be prepared to buy the dip. Get your capital ready. And guys, the best thing you can do, sit through the volatility, because things are going to get crazy next week. But I'm still of the opinion, buy the dip. It's just that this dip is going to come at a lot lower levels. And the dip we get into the S&P 500, it's going to be a garden variety 10% pullback. It's actually very healthy if we get one like that, particularly at the start of the year. And guys, like we do on this channel every single day, we're going to talk about sentiment. And this is a sentiment indicator we look at almost every single week. It's a staple of this channel. And it's the AA Sentiment Survey, a high volume, high frequency, high quality set of data that really does give us a pretty accurate view of sentiment as it is right now. And what we saw from last week is that bullish sentiment increased ever so slightly, but net, we'll call it largely unchanged. We saw those in the neutral camp decrease ever so slightly, and those in the bearish camp increase ever so slightly. And that just tells us that those that were in the neutral camp flipped ever more so slightly bearish. We did see a bit of an uptick. Bearish sentiment sitting well above the historical average. And then we actually look at bullish sentiment sitting actually below its historical average. So sentiment kind of turning. If for those of you that have been following this channel for a while, we were looking at readings in early December, late November. Bullish sentiment was very close to 50% right here. Bearish sentiment was like 23%. It was absolutely ridiculous. There was virtually no neutral campers right here. It was like 20% neutral. So the tides have turned significantly, and that's because we have seen a lot of market volatility. If we actually just look at the last 5 days, right, we've seen very volatile price action. We've seen days that have been negative and positive greater than 1%. We've seen days in the middle, 0.55% return. And then we've seen rather flat days to the upside and downside. Now, this is a very strong barometer. It's the first 5 days of January. And normally when we get a bullish first 5 days, it bodes really well for the average gain in that year. Normally we see returns of 18.7%, median well above 15%. And what can we see right here? The total change for the first 5 days of January was up 0.64%. That bodes really, really well for the new year. However, what I'm trying to illustrate is that the volatility we saw in the last 5 days is likely a precursor for what's to come in 2025. We are going to have bullish months. we are going to have bearish months. It is going to be very volatile in 2025, but I do think we are going to end the year higher than where we are right now. We just have to digest a lot in the way of the election, rates, Donald Trump, yields, geopolitics, and everything in between. But what do I believe the path is going to look like in 2025? I think it's going to look like the post-election cycle. And you could see right here, normally what we get is volatility in the first quarter, in the first trimester of the year. We then normally put in a low and we see higher highs, higher lows for 2025. However, there are some risks that could definitely derail this because seasonality isn't a crystal ball. It just allows us to assess the likely probabilities and outcomes of what could happen if everything goes according to plan. And that's especially true when valuations are where they are. Guys, and I think a big risk right now is actually earnings. If you actually look at one of the major key themes in the past month, it has been mega cap tech stock outperformance, both to the upside and downside, while the rest of the market has kind of stumbled. And this chart illustrates the dynamic perfectly. Drawdowns from the 2024 peak, the median stock is down 12.24% when the S&P 500 index is down 3% as of yesterday. And this really goes to show the mega cap outperformance we've seen. When you look at the top stocks, they've really been holding the index together, especially in the drawdown we've seen. Now, a big reason why is simply because over the last 90 days, we've seen some pretty dramatic upward revisions in the mega cap names: Nvidia, Alphabet, Amazon, Meta, Broadcom, and Tesla. And while this is encouraging, there also is a headwind with higher interest rates looming in the background. There is a rate these earnings could actually turn and start to see downward revisions. And if that is the case, we are going to see the mega caps pull back. And then this drawdown, especially in the S&P 500, is likely going to get deeper. And what really could cause those earnings revisions to turn, guys, is actually yields. Ever since the Fed started its cutting cycle here in September, we've embarked on 100 basis points worth of rate cuts in terms of the Fed funds. Since then, the 10-year treasury or bonds as a whole have actually rallied, and rising bond yields is not actually a mystery. In fact, it's actually entirely consistent with a short rate cutting cycle. In other words, the bond market basically believes the Fed is actually done cutting rates in this cutting cycle. And when the cutting cycle is over, what does that mean? It means upside for yields. And that's what the market is pricing in right now. If you look at short cutting cycles, you can see the average is when we first cut rates. This is what normally happens to the 10-year yield. Very much the same has happened, except we've seen a little bit of capitulation. And that's because the economy in this situation in 2024 is immensely strong. The macro is very, very favorable. And that is, again, part of the reason why we're seeing yields move absolutely higher. The labor market continues to chug along. And yes, we did miss on the ADP numbers. And when you look at it net, the economy did add 122,000 jobs in the month of December. And this is private payrolls, by the way. It doesn't even include public payrolls. Now, another barometer for the consumer, something we look at every single month on this channel, is the Costco monthly sales results. And right now, Costco reported net sales of $27.52 billion for the month of December. The 5 weeks ended January 5th. Now, it's not full 5 weeks. It's like 4 weeks and a couple of days. They just call it the full 5 weeks. And they saw an increase of 9.9% for the past 5 weeks. And the past quarter, they actually saw 7.7% gain. Guys, but all in all, the consumer, particularly the US consumer, looks rather robust, particularly when you look at Costco. And this is sort of like the middle class, the upper middle class, those consumers, they're looking very, very strong. They had a great December, and this probably bodes very well for Q4 retail stocks. Look at this 9.8% growth here in the month of December for the US market. You love to see that. Now, something else that was a bit concerning that I saw circulating yesterday, revolving consumer credit fell by 1% in November. This was the largest decline since August 2020. And normally when we actually get a decline in revolving credit by this much, it normally does signal that there is a bit of trepidation ahead. It normally does coincide with some major market volatility, particularly in the economy. We only see revolving credit decline when we do have a recession. However, I did dive into this quite significantly, and I think what we saw was consumers pull forward holiday spending. So seasonal adjustments are causing the October and November readings to be overstated, and then the December reading to come in what it is. However, this is something we are going to monitor, because if this is anything like this, it's definitely something we should be paying attention to. Now, diving into next week, guys, looking at data. Now, we have a very, very big week of data. I'm just going to cover the key points. Now, we kick things off on Tuesday with the PPI month over month. This is the producer price inflation. It's essentially what businesses pay. That's PPI. What consumers pay, you and me, that's CPI. We then get CPI here on Wednesday, month over month, year over year, the core and the headline figures. Now for PPI, we want to see a 0.2%. That's what we want to get. Then for month over month, year over year in core inflation, we want a negative 0.1 and a 3% year over year rate. And then for the headline rate, we want 0.3 and 2.3% respectively. I think this is the figure to watch. Negative 0.1%. A lot is riding on this core inflation month over month, because this is what the Fed looks at more than anything. Then on Thursday, we get retail sales month over month. The forecast is 0.5%. And then on Friday, we get building permits, housing starts, some residential fixed investment data. This is going to be a week that's really going to move the Q4 tracking figure for GDP. But what is going to move the market even more so than the data next week? It's going to be earnings. Guys, we have some of the big names reporting. Financials kick things off for the fourth quarter. This is Q4 earnings season. We're officially kick things off. I mean, we did kick things off this week, but I mean, the big banks start to report. And to kick things off this week, we have JP Morgan, United Health, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, BlackRock, Citigroup, PNC Financial, US Bank Corp, Truist Financial. Guys, all of these big names are reporting. We got the Bank of New York Mellon, Fastnell, MTB Bank Corporation. It's going to be a huge week of earnings, a huge week of data in a very volatile period as we approach the inauguration. Guys, be prepared for one thing next week, and that's volatility. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.